Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing what is a K-1 form and how is it used in real estate. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com. I'm not a CPA, so speak to one before making any investment decisions. The Schedule K-1 is an Internal Revenue Service IRS tax form that is issued each year for an investment in a partnership, like a real estate syndication. Investors will receive one K-1 per partnership annually. If you invest into a fund, you usually will just get one K-1 for the whole fund. Now, U.S. tax code in certain cases allows for the use of pass-through taxation. In other words, 100% of the income and expenses flow through the partnership to the owners and partners, landing on the owners and partners' tax returns. This shifts the liability from the entity, the partnership, to the individual partners who have an interest in it. The K-1 tracks the partner's basis in the business. Now, pass-through taxation is very good for real estate investors because of the favorable tax treatment it receives from the U.S. government. Most notably is the ability to defer taxes into the future and sometimes forever. The K-1 reports each partner's share of the partnership's earnings, losses, deductions, and credits. It is important to note, though, that the K-1 does not report the fair value of the investment. It simply reports the tax basis of the investment. For example, a business with two equal partners earns $200,000 of taxable income within a given year. Each partner would receive a K-1 showing $100,000 of income on it. Taxable income will increase the basis, however, expenses and depreciation will decrease the basis. If there are any additional contributions in the partnership, this will also increase the basis. It is possible for K-1s to show a loss, and it's normal for K-1s to show a loss with value-add real estate investments. This is because the income that is generated from these assets is deferred because of depreciation, and depreciation is a non-cash deduction. So a simple example would be a property that generates $100,000 of net operating income, but it has a depreciation deduction of $300,000. The business would report a net loss of $200,000. And if there are two equal partners, each partner's K-1 would show a loss of $100,000. The depreciation reduces the taxable income. The property made $100,000, but they are deferring taxes on this income with the depreciation deduction. K-1s are usually distributed by general partners in March or April of each year. However, it's normal for K-1s to be distributed much later. It is common for partnerships and investors to file extensions, especially if they receive a number of K-1s each year. It is best to alert your accountant sooner than later if you believe you're going to need an extension. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.